Hello everybody, my name is Mark, and in this video I am going to talk about how you can set up an income strategy or income investing using stocks that pay dividends. And I've already done the homework. I've already found a really nice stock that pays a nice dividend, and this is Blackstone Group LP. And the reason why I like this stock, it has good fundamentals. It has a very big market capitalization of $21 billion. So you find more stability in large cap stocks than you do the small cap ones. It wouldn't make a lot of sense to buy a stock with only a, let's say, $200 million market cap, even if it paid 10% or 20%. Be pretty risky, right? So when you find these large market caps, you get more stability. And an income strategy with dividends, or I should say stocks that pay dividends, need two things. It needs to have a good return in their dividend, and number two, it needs to have some stability, and that's what the large market cap is for. So I like this stock. It has a positive earnings per share of $1. It looks like about $2 per share, and that's projected to grow in the next year. And it also gives a very good return on equity. I think that's above 20%. So very good fundamental wise stock. This is a financial stock, and we can read the description of what it does here. It operates through private equity, real estate, hedge funds, and credit. And you don't need to know everything about the stock. You just need to know if it's going to be around a while, at least for as long as you're going to own the stock and collect your dividends. So I like this stock, and so I'm going to use this stock as an example if you wanted to set up an income strategy. So the dividend is $2.39 a share, or 7.34% yield. And I think that's a pretty good return on your money. Okay, now you need to have a lot of money if you're going to set up an income strategy, because the key component, and I did a video about this, the key component of income is making withdrawals from your account and using that money for income to pay your bills, gas, food, groceries, whatever, right? So you need to have a lot of money, and it wouldn't make sense if you had $10,000 and then you collect 7.34% on that $10,000. You'd be making a whopping $734 a year, and that's hardly nothing, right? That's not even $100 a month. So if you had $100,000, then you would be getting 7.34%. You'd be making $7,340, and that's decent. At least you're making $600 a month, more than $600 a month, and that's decent, I think. So you need to have a lot of money to set up an income strategy, because an income strategy, you are making regular withdrawals. So what you want to do is, let's say you have $100,000. The closing price of this stock is $32.58. So you could get, 3,000 shares of this thing? So let's say you got the 3,000 shares, and then you would be making 3,000 times $2.39 per year. So 3,000 times $200 would be $6,000. And then you add another 40 cents, and that would be 3,000, let's see, 1,000, so 400. That'd be about $7,200 a year, a little less than the full 7.34%, because you don't have quite 100. So you'd be making about $7,200 a year. That's $600 a month, and I think that's pretty darn good. So every, let's see, how often does it pay? Does it pay quarterly? Let's see, let's go to the earnings and find out how often it pays. The next earnings announcement is July 20th, 2017. So that's coming up in about a month and a half. Today is May the 29th, 2017. And so I'm guessing that this pays quarterly dividends. So you would get 1/4 of $239, which would be about $60, right? $600 a month. Or no. Would that be right? 600? No, I guess you get $1,800 because you have 3,000 shares. So that would be pretty good to get $1,800, and then you take that $1,800 and you spend it on whatever the heck you want. So that's the first thing you do, is you buy 3,000 shares of this thing, right? And that would be a pretty big order. And click review order, and there you go, $98,000. So you'd still have some money left over out of your $100,000. I'm not going to place the order. I don't have $100,000 in my account. But if I did, then I might select this stock for a nice income strategy and make $600 a month. So now I place the order, which I'm not going to do, but I would place the order, and now I would own 3,000 shares of Blackstone at this price right here, $32.58. And then every 3 months I collect those dividends. I get an $1,800, not a check, but it would go to my account, and then I'd withdraw it, spend it on whatever I want. Okay, now the dividends are nice. Now the second part is I want stability. Okay, so what I personally would do is I would go to the stock options, and I would sell a call option, and I would be very conservative, because the whole point of an income strategy is stable income. Okay, if you had a job, you would want a stable job, right? Because your job gives you income. Well, same thing with the stock. You would want a stable stock that pays you a stable income. And one of the ways you can do that is by selling call options. So I would go out long term a little bit, and first I would look at the chart, and I believe the recent support was at about the $25 level there. And so let's see, that's about a 3 years period. So let's go to the 3-year chart. And the 3-year chart indeed is showing a $25 level. So I would look at selling $25 call options as my stability, kind of like my insurance. So I would go out a little ways, maybe to $200. I go to in the money like this, view my option chain, and the $25 calls are going for, the bid is $750, the ask is $780. So let's say $765 per contract. So I take the $765, add it to the $25, and that brings my average up to $32.65. The change here, or the last price, is $32.58, so that's about a break even. Okay, and the whole purpose of selling the call is to create a hedge in case Blackstone decides to go down. It can go all the way down to $25, and I wouldn't lose any money. If Blackstone decided to go below $25, then I'd start to lose a little bit of money out of my principal. But maybe that's okay. I would make money on the calls, and then maybe it would bounce back, right? Stocks go up and down all the time, don't they? So maybe it would go down, it would go up and down or something. I don't know. Whatever Blackstone decided to do, it could go all the way down to $25, and I wouldn't lose any money. Now, what could happen is that, let's say in 200 days rolls around, and Blackstone is still around this price level. It's still around $30 price level. Then what would happen is, on the day of expiration, which is December the 15th, 2017, on the day of expiration, I would automatically sell my 3,000 shares at $25 a share. And that would be okay, because I collected, let's see, let's go back to in the money here. And I collect $765, right? So that would be okay if I sold it at $25, because I would collect $25 a share times 3,000, so I would get all that money, which would be 75 grand plus all this premium. Okay, so there would be absolutely nothing wrong in the world selling my shares, because I would just break even on the share, and then those dividends I collect free and clear. So that's the whole point of creating a nice, safe income strategy. There are other ways to create stability for yourself. Doing credit call spreads is another way. If you wanted to take a little bit more risk, and you were bullish on this, and you actually wanted to try to combine growth with income, you could do that. And you would maybe come here and I don't know, maybe, oops, sorry about that. Maybe you would sell a credit call. Let's see, the price is $32.58, so maybe you would go a little bit out of the money, and maybe you would look at this one right here. Looks like this one is giving about the bid. Let's see, you would do a bear call. So the bid would be $23 and the ask would be $34. So split that in the middle and you would get what? About $29, let's say. Let's say $29, and that's out of a $1 spread. That is a 29% return, which is very good. But if the stock went up, then you would start to lose money on the spread, but you would be making money in the shares. So the money you make in the shares would make up for the money you lose in the spread itself. And if the spread goes down, and actually if you were to do that, I wouldn't do long term. I would do more shorter term, like maybe go out to July and look at the $1 spreads, and the money is lower. The bid is only $4. The ask, that's a very, and by the way, that's a very large spread between the bid and the ask. So I don't like that very much. I like to have small spreads, tight spreads. So maybe I'd look at this one, right? Maybe this is a better one. So I would split those two in half, and that'd be like about 22. Maybe I'd try to get 20 cents there and get a 20% return. And since I have 3,000 shares, I could do quite a large number of contracts. Because if the price of Blackstone went up, you would lose money on the spread, but you would make money on your shares. And actually, you know what? You might want to do the same number of days. Or no, I guess you could do the short terms and you'd be okay. So what did I pick? This one? Was it? Yeah, it was this one. So let's say you get 20 cents, right? And then you could, let's see, 3,000 shares. So every 100 shares you could do one contract. So that would be 30 contracts you could do. So 30 times 20 is, lo and behold, $600. Big surprise. It's funny how the math all seems to work out, but that'd be another way to hedge. Now, the danger of this particular hedge is that if the stock went down more than 20 cents and the dividend, it's really not a very good hedge. Okay, the better hedge is just to sell covered calls, just to sell call options, and to be conservative, because the whole point of income strategy is to collect the dividends. So if it was me doing this, I would go to the calls and puts, and I would look at the in the monies, and I would be looking at this $25 call, and I just collect $765 per contract. Now, I have 3,000 shares, so one contract would be 100 shares, 10 contracts, so I could do 30 contracts. So 30 times $765 would be, well, let's see, 30 times 1,000 would be 30,000. So 30 times 7 would be 21,000. 30 times 8 would be 24,000. So you get about like $23,000, and that would all be as a hedge in case it dropped. And if the price of Blackstone drops, then the price of your call option would decrease in value, and you would make money on this call option. Now, when you collect that $21,000, you don't withdraw that. You keep that in your account as your hedge. It's your insurance, just in case. The purpose is to protect your principal. Okay, I mean, if you're going to buy 3,000 shares of this stock, that's $98,000. So that $21,000, you need that money in case the stock goes down, and then you can buy back your call options at a cheaper price, and then maybe sell another one. Maybe sell another one at a lower strike price. Maybe you'd have to go way out here or something, right? So you'd have to keep a little bit eyeballs on your investment. You wouldn't want to just put your money in to a stock like this and just forget about it, but the maintenance would be very minimal. All you'd have to do is if the stock dropped, you just make sure you buy back your call options and you keep the ball rolling, roll it out, maybe go out to here or go out to here, pick a lower strike price, and by doing that you can live comfortably off of this. Let me see here. You can live comfortably off of this 7.34% for the rest of your life, or at least as long as the company is a stable company, it's growing, and it pays this dividend. Now, companies can and do sometimes cut their dividend, or they raise their dividend. You know, here's a stock that I just want to show you as an example. JCPenney. Here we go, JCPenney. And let's look at this. It's only a $4 stock. What's the market cap on this thing? 1.5 billion. It's still got some market cap, but if we look at this chart, okay, this chart there's one more thing that I need to do here. Where's it at? The comparison. Here it is. Comparison. Show dividends. Okay, so you can see all of the life of JCPenney is paid a dividend, is paid dividends. Now right here, it even shows you how much dividend it paid: a 54-cent quarterly, 55 cent, and then 55 cents. And then we go up a ways. Now it's only 13 cents. We go up a more of a ways, still 13 cents. Go up more of a ways. They raised it to 18 cents. Go up here, 20 cents. Now we keep going up in time, 20 cents here. And then bammo. That's the end of their dividend. And so for five years ago, they quit paying dividends. Okay, that's a pretty bad sign. Okay, so companies do that when they're not doing well. JCPenney has not been doing well pretty much since the inception of Amazon, like a lot of retail stores. Okay, so I would not buy a dividend stock in the retail store business, thanks to Amazon, which is taking over the retail store world. And it's putting a lot of stocks like this out of business. Okay, so that's something to keep in mind. But back to the good stuff. Back to Blackstone. Blackstone, I think, is a great stock. You again, you should have a lot of money when you are doing an income strategy. It's really not worth it if you don't have a lot of money. But if you do, if you had $100,000, making $600 a month just for hanging on to a stock like this is a pretty good deal. And then you could sell a call option, like I explained earlier, to create some stability to protect your principal a little bit. And by doing that, you can go to sleep at night. Let me bring this up one more time. In the money. And here it is right here, the $25 call option. So if I had the $100,000, that's what I would think about doing. Maybe I might find something better, but if you like this stock, then that would be a good thing that you could think about doing. You could collect the dividends, you could go to sleep at night and not have to worry about too many market crash, not have to worry about the market crashing. $32 minus 25, that is a $7 drop. That's about a 20, you're getting 20% protection in the next 200 days, and I think that's pretty darn good. So that's it for this video. Thank you for watching. I hope that this video you learned something about how you can buy good stocks that pay dividends and have an idea how to recognize a good stock. And I will see you in the next video.